probably, one layer deeper of analysis, if attention is all you need, and if you're not post-economic, you need to pay attention to who's making money. And in AI, it's basically one company is making, Nvidia is making over 100% of the profits. Everybody else is collectively losing money. And so there's sort of you have to do some sort, you should try to do some sort of analysis. Do you go long Nvidia? Do you go short? Is it, my monopoly question, is it a really durable monopoly? And then it's hard for me to know because I'm in Silicon Valley and we haven't done anything in semiconductors for a long time.
Welcome to Personal Finance Cat, where I share my personal take on personal finance. All right, today we're going to talk about Nvidia again. I'm sure you've all heard that Nvidia did a 10-to-1 stock split in June this year, 2024. So does that create a buying opportunity? I've heard this theory that when a company splits stocks, usually it implies that management is very optimistic about the company. And that's why the board approves to do the stock splits. The idea being that with the lower stock price, more investors would be willing to buy into the stocks. That's pretty much the theory. Do you think that makes sense? Let's Google it. Okay, here's what Google AI provided. The stock split in June made it easier for investors to buy shares and participate in the company's growth. Okay, the reasons are lower cost per share. So it went from 1,200 to around 120, making it more affordable for investors. Increased liquidity. Okay, I guess that makes sense because there are more number of shares available. More flexibility. Investors can buy or add to their position with a smaller budget and can reduce their position in smaller increments. More accessible options. The split can make options more accessible to investors, which can increase trading activity. Okay. However, the stock split doesn't change anything fundamental about the company or the value of an investor's holding. So here, that's the key point. It doesn't matter because at the end of the day, you care about the market cap. And in this case, the market cap is really high. I think Nvidia is one of the few trillion-dollar companies. Recently, it's valued at $3 trillion. And as Warren Buffett always says, you should value the stock as if you're valuing the whole company. So the question is the company overvalued or is there still buying opportunity for a value investor who always goes out and look for undervalued stocks? Before I go into the quantitative analysis, I do want to address a little bit of the qualitative side. To do that, I usually try to look at their 10Ks, listen to their earnings calls. And I did listen to the latest one, which is their Q2 2025 earnings call, I believe. It was a very good picture that they're presenting. Jensen Huang, as usual, is very confident, technical, and just so down to earth. I believe he's really a good leader for the company. And he's also the founder, which is an added benefit because founder has the vision and he also happens to be a great manager to manage this established growing business, which is very unusual. It's almost like he is an overnight success, although it took him 20 plus years. I think the company, even though is doing great, they're not putting their foot off the gas. They're doing a lot of great things in terms of research, in terms of expanding their customer base. For example, one of the things that he mentioned is that, yes, there are these big customers like Meta, Microsoft, Amazon, who all need to use their GPUs to do AI research. But then there are a whole bunch of startups now that just kind of happened during the last couple of years when the AI boom is happening. And those companies would also use NVIDIA's products and services as well. So all I'm trying to say is that NVIDIA is really well positioned in this environment because AI is a revolution. You might say it's a hype, but recently I listened to this interview with Sergey Brin, the founder of Google. He was talking at the All In Podcast Summit. He was saying that even in his career as a computer scientist, as a founder in the tech company, he had never seen anything like this. I think it suffices to say that it's probably not just merely a hype. There is really some fundamental changes happening in the AI industry. I'm not a technical person, so I can't really talk too much about it, but I'll take the word from such a well-renowned, such a respected person as really a proof that AI is not going away anytime soon. If anything, the growth is going to be exponential. Anyway, I think there is qualitative answer to this question, which is Nvidia is going to continue to grow. It's hard to predict whether there's going to be another competitor that comes along and changes the dynamic, but at least in the next few years, Nvidia will hold strong. All right, so let's look at some of the numbers. I usually go to Seeking Alpha because they have a pretty good presentation of the financials of the companies, at least for 5 years or so for unpaid customers. And as you can see, the growth is really astounding. In 2020, their revenue was at 10.9 billion, but the latest 12 months is 96 billion. That's almost a 10x growth. And the bottom line also is growing at a similar trajectory, if not better. In 2020, the operating profit was 2.8 billion, and the latest 12 trailing month is 59 billion, almost 60 billion. You can't ignore this kind of growth and say, all right, it's not steady. I'm not going to look at it. I'm a value investor. When something like this happens, you know that it's not usual. It's very rare, as a matter of fact. If you don't want to miss out value opportunities like this, at least you should take a look. And that's exactly what I'm trying to do. Monish Prabrai also recently talked about Nvidia. And as usual, he didn't really say one way or the other whether the company is going to do great or not, but he did have an interesting point. Let's take a listen.
I would say that there's a lot of euphoria around NVIDIA. And if one were to do some type of analysis of a discounted cash flow model, where you look at the earnings of NVIDIA today and you do some projections of what you think their earnings are in 3 years or 5 years or 10 years, and then you discount it back, I think it'd be difficult to justify the $1 billion or $1 trillion market cap. It'd be difficult to come up with a future cash flow stream in the next 10 years or so that would exceed that.
Okay, so as Monish Prabrai said, if you do a discounted cash flow model, you probably won't get the answer that you want. And that's exactly what I did. As you can see here, with 4 valuation methods, only one came back as maybe perhaps Nvidia is a watch, meaning that it's not quite at the price to buy it, but you can keep an eye on it in case the price falls below a certain level. In my case, I just assume that if the price is more than half of the current stock price, then you should keep an eye on it. But then the other 3 methods, DCF, 10 cap, and payback time, all indicates it's a sale. And it's a strong sale because the valuation based on those methods is a fraction of the current stock price. And as of today, the price is at $119. So let's take a quick look at how I derive the price under each of the valuation method, starting with DCF. And this is what Monish was talking about, looking at the next 5 to 10 years of cash flow, and you discount that back to today's dollars and see what is the price that you can buy at. And this method I based on the book that was written by Mary Buffett, who is the former daughter-in-law of Warren Buffett. The key concept here is return on equity. The idea is that when you have equity in a company, which is basically the money you put in, what's the return that this company can generate for you? You don't probably care about margins. A company like Costco, for example, they can have very thin margin, but that's just a metric that's based on sales. Because if they can just generate cash for you with very little capital, that's a great business model. It doesn't matter how thin their margin is. So that's why return on equity is a key metric for an investor to look at. In order to derive that, you just basically take the shareholder equity and then divide that by the shares outstanding to get to the equity per share. And then you also look at earnings per share, which is readily available. And you can basically see how much the equity is returning to you in terms of earnings. You want to look at a company that has steady equity per share and steady return on equity. In this case, for Nvidia, we already talked about it. It's not a steady company. It's really a high growing company. Therefore, naturally, you can see a very high growth for both equity per share and return on equity. The reason we care about dividends also is because you have these earnings, but then you give out dividends as well. What's retained is what you can put back in the business and continue to generate more cash for you. Nvidia does give out dividends, unlike a lot of the other tech companies. In the last 20 plus years or so, Nvidia wasn't necessarily considered the hot stock. So in order to attract more investors to invest in their stocks, they have been giving out dividends. So we do have to subtract that from the earnings per share to figure out what's the retained earnings. Anyway, you take this growth rate for equity. The idea is that if a company is growing, they should be having some earnings and add into the equity, and then the equity generates more cash, and that just cycle just goes on and on. We just have to figure out what's a reasonable projection in the next 10 years or so of the growth of equity, and then therefore the growth of earnings to figure out in 10 years, what are we looking at in terms of the earnings per share. And as you know, the PE ratio is basically price over earnings. And if you have a reasonable assumption for the PE ratio in the future, as well as the earnings in the future, you can get to the future price of the stock. And based on these assumptions that I just talked about, the average equity growth from the last 10 years of data, the average return on equity from the last 10 years of data, respectively about 19% and 25.8%. So with those assumptions, we get to basically a future earnings per share in 2034 at $2.49, up from $1.19 in 2024. And what does that translate to in terms of a future price? So the earnings at $2.49 multiplied by a P ratio. Here we are assuming it's 37.45, which came from Seeking Alpha. Then we get to a future stock price in 2034 at $93.26. So as you can see, even the future price in 10 years is less than the current stock price. And if you discount that back to today's price at which you should be willing to buy, assuming that it gives you a 20% return, it's only $15. There's a huge gap between what this DCF model gives you versus what the current stock price is. But again, there are a lot of assumptions. First of all, the equity growth and the return on equity are very conservative. If you look at the latest year, which is 2024, the return on equity is 69%. Can they continue this going forward? It's really hard to say, but it's not impossible, at least maybe in a short amount of time, like let's say less than 3 years. But to be conservative as a value investor, this is usually the assumptions that you would use. And again, when we look at companies, we are looking for the steady, monopolistic companies that even though they're not growing like crazy anymore, at least they're holding things steady and growing steady. So in those scenarios, it's much easier to say an average is reasonable. Here, it is a little bit difficult to really say that this is fair enough. Regardless, let's just take the conservative side and see what the numbers look like. The next method is the 10 cap method. And if you don't know what 10 cap means, it stands for 10% capitalization rate. The idea is that if you put in a certain amount of capital, you're looking for a 10% return. And you might say, that's not a very impressive return. However, when you look at real estate deals nowadays, 10 cap is impossible pretty much. The prevalent cap rate is about 2, 3, 4%, which is what people are trying to sell to investors. So 10 cap is actually really difficult to obtain. But in a stock market, you can actually more easily find a 10 cap deal. In order to calculate the 10 cap price, you need to start with something called owner earnings, which is a concept that Warren Buffett has first came up with. You don't want to look at GAAP income. GAAP is generally accepted accounting principle. And there are a lot of things that accountants do that don't necessarily correspond to the actual earnings that you make. A good example would be depreciation and amortization. And what that is when you buy a heavy piece of equipment, let's say, you don't just put that in your P&L right away. You would depreciate it over time because you will use that equipment over a long period of time. So it's not fair to have that hit your P&L right away. Instead, you should average it out in the next 5 to 10 years, let's say. But as an investor, you really care about the cash that you get every year. So you have to do these adjustments to make sure that when you look at every company, it's apples to apples. You might have years where you heavily invested in some things, but you have years that are quiet. So how do you smooth out the owner earnings to give you a very stable picture of the business? What we do here basically is to add or subtract those items that are due to accounting, but instead you put in something that's a better assumption, which is the maintenance capital expenditure. The idea is that on an average basis, how much are you spending on your CapEx or capital expenditure? So we are looking into the future and we're looking for basically a more reasonable measure of the profit that the company generates. That's why we do these adjustments. Without going into detail, this adjustment actually doesn't really change NVIDIA's income that is reported in their P&L that much. So in their latest P&L, which is 2024 P&L, their net income is 29.76 billion. But then with these adjustments, we come to 32.107 billion. Rest of the calculation is very simple. You basically multiply that by 10. That's what the 10 caps comes in. It goes from a 32 billion owner earnings to a 10 cap price of 321 billion, which is also the market cap. And then you divide that by the number of shares outstanding and you get to the per share price. It's only $13. That's far different from the current stock price of $119. Interestingly, it's actually very similar to the discounted cash flow price. All right, the next one is called the payback time. So the idea for the payback time, I think, came originally from Charlie Munger. On average, the stock would return all your cash in 16 years, meaning if you put in $100 in about 16 years, the free cash flow it generates can pay that $100 to you. But because as value investors, we don't care about the short-term fluctuations, it's almost as if we're buying private companies. You might have heard of this concept that if you hold something that's not liquid, you actually have a premium because your money is tied up. Because we have that mindset that we are not going to take our money in and out anyway, we should be looking for companies that can return our cash much faster, like half of the time, which is 8 years. That's why in this payback time method, we assume that in 8 years, we want to get all our cash back. In order to do this calculation, we have to figure out the free cash flow that the company generates. You start with the cash flow statements of the company. And in this case for NVIDIA, it's $28 billion. And you do certain adjustment, which is very similar to what we did in the 10 cap method. It's not a big adjustment for this company. The net cash generated by the operating activities based on their cash flow statements is 28 billion. After our adjustment, the free cash flow becomes 27 billion, so slightly lower. You grow this free cash flow based on assumption of what kind of growth rate you're looking at, and then you add all those free cash flow up over the next 8 years. At the end of that 8-year period, the cumulative cash flow should pay your initial investment back. So essentially, that amount should be the price. You take that amount and divide by the shares outstanding to get to the per share price. And in this case, after 8 years, you would accumulate $673.8 billion of cash. And you divide that by the 24.94 billion of shares outstanding, you get to a per share price of $27. So this is a little bit higher than what we derived from the DCF and 10 cap methods. But still, it's a far cry from the $119. Again, here, the growth rate is a key assumption. I took the 25% growth rate, which is one of the growth rates that Seeking Alpha has provided. And I can quickly show you here that there are many, many different growth rates that Seeking Alpha projects. I pretty much took the lowest growth rate because we want to look at the long term. And this is the growth rate, which is a forward-looking long-term growth rate for the 3 to 5 years time horizon for earnings per share. But if you look at some of the other growth rates, EBITDA is probably one of the largest ones. EBITDA is projected to grow year over year at 394%. That's a much bigger growth rate than what we assumed. But it's not that unreasonable, to be honest, because you already saw in the trailing 12 months compared to the 2024 results, it was already doubling. And the 12 month is not ended yet. So anyway, suffice to say, we're using a very conservative approach. And lastly, the margin of safety. This one is probably the most arty. Valuation is an art, not a science. So the assumptions are sometimes a little squishy. This method comes from the book by Daniel Town, who is the very famous investor Phil Town's daughter. And in this book, which I believe they co-authored, they literally called this growth rate windage growth rate. The reason is when we're projecting something, it's not accurate for sure. But what is a reasonable assumption? In this case, the reason why we have to assume a growth rate is because we have to grow the earnings in our projections, and we also have to come up with a PE ratio. In their method, basically, whatever growth rate you assume 2 times that is the windage PE ratio. In my calculation, I use the 25% again here as the windage growth rate. And that implies that the PE ratio is 2 times that, which is 50. And then you also look at the highest historic PE ratio. In this case, it's 144, but you take the lower of the two. So essentially, you still use 50 as the PE ratio. And then you take the current earnings per share, which from our previous discounted cash flow method, you saw that it's $1.19. Then you calculate the future value of the earnings per share. You basically grow it at a percentage, which is at 25%. In this calculation, we derive the future earnings per share at $11.19. And with that earnings per share, we can derive the future stock price, which is simply the PE ratio times the earnings per share. So you multiply 50 by the $11.19 to get to the future price. And lastly, you discount it back to the present value with a 15% discount rate. And that gives you $139. That's basically the present value of the stock price. And the reason why we use 15%, not 20%, as in the discounted cash flow model, is because we would do a last step, which is to divide that price by 2 to be conservative. That's why it's called the margin of safety method. So with all these conservative assumptions, we derived a margin of safety stock price of $69.48. It is more than half of the current price, so that gives us the watch recommendation. Again, there are some assumptions that can potentially be changed, and arguably maybe these assumptions are too conservative. But as a value investor, you want to use these conservative assumptions. If it still gives you a buy recommendation, there's no question in your mind that you should buy. But this one is really debatable in my mind. And that's why traditional value investors wouldn't even look at this. To be honest, I feel like for a growing company like this, how do you put value on that kind of exponential growth? My opinion, if there's a dip, like what happened 2 weeks ago, you buy a little bit. And that's what I did as well. It's probably overvalued, but if you don't put that much of your portfolio in there, it's probably not going to hurt. I wouldn't go all out on this because yes, it's a great company. It's not undervalued, to say the least. Anyway, that is just my view of Nvidia stock price today, which is September 13th, Friday. If you're really familiar with the AI industry, you might have a completely different view. You might be very bullish about it. Let me know in the comments section. What is your position on Nvidia? Would you buy? Or if you already have some Nvidia stocks, would you hold? Thank you very much for listening and watching. Bye for now.